All right, we are just under a minute away from getting things going. Shout out. We've got Diamond Handsies in the Twitch chat. Welcome. I think a lot fewer viewers than normal, but hopefully that means everyone's out enjoying their weekend and you'll be able to watch the replay whenever you feel like it. All right, and that is the timer. We are going to get things started just pretty much right on time. We finally got it out the door at 9 o'clock this time. No technical issues getting the stream started. But for those of you who are on live with us right now, thank you for joining us again for another week of our trade ideas and stock market analysis as we head in to the week of August 15th. We're going to do this the way that we always do it, where we do a quick recap of everything that we had in the past week, and then we'll jump ahead to what we're holding for next week, which is probably a lot more relevant for what you guys are interested in hearing about. But nevertheless, I think there's a lot of good stuff to talk about with what happened last week. So, I mean, the first point we want to make, and it's the point that we make at the end of all of our streams each week, and it's that so much happens on a day-to-day basis in the market that we could come out with this really nice big plan Sunday night, and that could all go out the window and we go in an entirely different direction as the week progresses. And not to say that we didn't have a plan that we executed on this week, but if you take a look at the new plays that we entered into, these are really trades that opened up, the window of opportunity opened up as the week progressed for us. We made about $4,300 from those trades, and our net profit on the week was $36.11. So, I mean, without those new trades, we would not have had as successful of a week as we did. But with that said, we made $36.11 last week. That was a 2.45% return when the S&P 500 returned 0.78%. So we outperformed by 1.67%. So once again, that's a huge winning week. It's always a winning week when we make money, but it's an even bigger bonus when we outperform the S&P 500 because that's our main goal. If we take a look over at our year-to-date summary chart, we've got a pretty big lead so far. We've got a 75.29% return on the year overall compared to the S&P 500 return of about 19.27% so far. So that's a pretty big lead that I doubt we give up in the in the next 4 months, but we're not going to take our foot off the gas. We're going to keep things going just the way that we have and keep playing with the strategies that have gotten us where we are today. So top to bottom, UWMC, we talk about this one pretty much every single week just because it's at the top of the list, and it's a trade that we've held on to for a little bit of time. Shout out to Jules right there joining along in the Twitch chat. Welcome. But they've got earnings this week. I'm not positive what day. If we scroll down here, we could see they've got them 8:16 before market. So it's tomorrow morning before market. So they're coming up quicker than expected for us. KB in the YouTube chat, what's going on? Appreciate you checking in again this week. But UWMC, we've got those 7.5 strikes. We've got a lot for December, which are really just kind of sitting in the back of our portfolio as we wait for that one to play itself out. But maybe more importantly, on a week-to-week basis, are these 20 that we have expiring this Friday. If we take a look at the price right here, it finished plus 5.5% on Friday, which was a really nice run up to give us a decent cushion as we head into earnings. And then in the after hours period, it jumped up past $8 a share, finishing between 801 and 803. So we've got a really, really nice premium as we head into earnings, which, UWMC, we're in this trade because we fundamentally believe it's a really nice, strong company. So we're not terribly worried about earnings. What's going on with this one is if it stays above 750, aka if it doesn't drop 50 cents in the next 5 days, these are going to expire worthless. We're going to make about, come on, $700 on that for the week. So that's a decently, high probability level of return right there. Excuse me, I should be looking down here. It's going to be the same number though. We'll make 500. It won't be the same number. We're gonna make $560 on those because they started off at 0.28 as opposed to the 0.35 we had up there. But again, if it stays above 7.5, that'll be a nice $560 profit. as we get our day underway. Diamond Handsies with a little bit of fact checking going on there in the Twitch chat, saying that it's actually tomorrow at 4:30 p.m. Eastern time, so after market. Interesting. They've got this listed as before, but the call is listed as after market. So we may know the number is before, and they might not have the call until after, which, is kind of atypical, but I think that is something that's happened before with this company. So hopefully we get the numbers out of the way. They're good, and we can kind of coast on that one as we head into the back end of the week. ICLN, not even worth talking about. Corsair is another one. Unfortunately, this big position that we've been holding on to week after week after week, but the stock took a dive and cost us about $1,900 just from the stock movement itself. Now, we did recoup a little bit of that from the covered calls that we've sold, but we also lost a little bit more from the cash secured puts that we sold to leg into a strangle on this one. But overall, our break-even price is $28.81 right now. We're down a decent chunk of money on Corsair, and that's just what's going to happen when you leg into a decently sized trade that drops 30% on you. But it's not all is not lost yet. We're going to wait until the end of the week to reevaluate what we want to do on this one. But it's so beat up lately. If we take a look at Corsair's chart, CRSR, and we have hopefully RSI plotted on the bottom here. Now we have implied volatility. Let's add RSI in really quickly. All studies, head over to RSI. And we back out to the 150-day. It's relatively oversold. It looks like that we may run into some decent support right at this level, the 27-ish level, because that's where it previously bounced if you ignore the bottom wicks on these candles. But area we can expect it to rebound from. Now, ideally, what happens this next week is that Corsair runs back up to 27.50, in which case we'll get that gain on the stock. These will expire worthless, and these will also expire worthless, and we'll hit the trifecta. We'll get a nice $3,500 of profit on that. But, if not, we're just going to keep doing what we've been doing. We are expecting a bounce based off the support that we potentially see on this chart, based on the level that we see on the RSI. So we're going to hang steady with that. And even if we do back it up again to that 180-day view, we are kind of in some sort of uncharted territory in the last 180 days. You got to back it up about a year until you start seeing back where it traded at before. But again, we drew this line a while ago because this is where you extend back to where it was trading in October and November of last year, where we saw a little bit of chop. So this is about where we expected that level of support to come. So if it stays around this level and bounces slightly, we may keep the strangle going for another month. And if we did do that, you take a look at the September premiums that they're offering right now, we'd probably stick with exactly what we've got, maybe. The 27.5 call and the 27.5 put. Those together offer about $1.10 and $1.70 in premium. So that would be a $2.80 decrease in our cost basis, meaning that this would get down to, what's this, minus 280. We'd have our break even down to 26.01, which is above where the stock is trading right now, and that's a perfectly manageable place to have it moving forward. So I'm leaning towards doing that because we've got a decent chunk of money objectively, but as far as the percentage in our portfolio, we have about 17 or 18% allocated. So I'm okay to leave that in the back of my portfolio for another month or so as we get to these September expiries. Would have really liked if we had some weeklies pop up, but that's all right. That's just part of the territory with this stock. So that is probably what we're going to look to do at the end of the week. But again, one of those things where so much can change in the next 5 days. So we'll keep that situation updated for those of you who are in there on that one with us. Zillow, one that we've gone back to the well so many times when it gets down to this high 90s, low 100s area where we've identified support. We were able to scalp about $360 off that one. Nothing really brewing in the IPOF or PSTH, our option buying trades that we've been in on. PSTH had, honestly, we could take a look at the chart of PSTH really quickly. They had a little bit of a ramp up. Obviously, if we've got this thing zoomed out to the 1 year, it's not going to look like too much. But if we zoom into the monthly chart, we bottomed out around this 2015 area. We saw a push up towards 20.4, so that was pretty encouraging. Again, reminder, we only need to get up here to double our investment on that trade. And, it might look like a lot when we're looking at the 1 month chart, but again, keeping in mind we have 2 months until expiry of those long calls that we purchased in October, as in the expiry is in October. And if you back it up to that 180-day chart, this red line really doesn't seem like too big of a bounce in the scheme of things. So that's the idea behind that one. That's what we're holding on to. But again, not too much happened in that one this week. The price of those options ticked up 10 cents, which got us $150. But we've got bigger things in mind for this play, and we have plenty of time, right? It's only August 15th, so we're going to hang tight for now with that one. AMD was the back end of a call credit spread that we opened up a couple weeks ago, so we just got out of that one to preserve some profit overall. It would have finished at max profit, so maybe a little bit of regret getting rid of that one and leaving $700 on the table, but one of those things where we can only trade based off what's going on in front of us. If we see profit on the table and the trade's starting to get a little bit risky, it's a smart move to take that off the table, cash that money out. I mean, it looks like 20 right here, right? But if we go back up to the week before, there was another $200 of that. So we took our $220 overall on that trade and kept things moving. Now, Moderna is a super interesting one because we had a credit spread on this. Super similar thesis if you've been following along with that AMD trade that we came up with, where there was super, super high. We could pull the chart up here to illustrate this. We talk so much about RSI on this channel. We're back at the 180-day. This is that 180-day RSI that we were talking about. It was flying above 70. It was up to the mid-80s, which is just an obnoxiously high level of RSI. We'd look to previous points where RSI got to those elevated levels. We saw pullbacks. Similarly here where it got elevated up to just about 80 and pulled back. And once this thing finally got up to those mid to low 80s, we saw an enormous pullback on that one. So that one actually worked out really, really well for us. But what's interesting when you take a look at our profit tracker here is you're not just going to see the 6 spreads that we sold, right? What we did was we actually messed around a little bit with the short leg that we had for the long leg that we had, the 5-10 call. So what we did up front was we sold 6 of these spreads. And what happened, for those of you who were in with us, was this green candle just kept on running. We got in right around at the 450 level. We could zoom into the 20-day here. We got in right around here because it looked like it was starting to maybe slow down and level off, but that was not the case. It kept moving straight through 450 and was flirting with 500, but by the time, that Thursday, I forgot what day this was of the week. I think it was a Monday. There we go. It was a Monday. By the time we got there on Monday, we got to a point where since we entered at 450 and it was a bearish call spread, we were losing money. But about call spreads is it has a short leg and it has a long leg. And that long leg, when the stock runs up like this, is going to increase in value. So what we did is a little bit risky, but we figured it might be worth it, just again due to us being so sure about this RSI idea right here, and it paid off big time. But what we did was we got rid of the long leg, right? We got in on 6 of the long legs for $7.96, and by the time it was flirting up with 500 by the end of the day on August 9th, this long leg was worth 26.2. So we said, hey, why don't we just get rid of the long leg at 26.2, wait for an inevitable, at least seemingly inevitable cool off, and then jump back in, recover that short leg when it gets a little lower. So what we did is we sold the long leg at 26.2. We waited for it to cool off a little bit and then bought it back at 21.95. So what happened right there was the difference between, this 26.2 minus the 21.95 actually got us about $425 right there just from scalping the pullback. Now, that did leave us to unlimited risk technically, but it's one of those things where this is a larger cap stock. It was moving up so much. We had a lot of conviction with this RSI reading right here, so we were comfortable with hanging back and waiting, maybe not for this thing to crater to zero to get back in, but for like a $400 or $500 arbitrage, maybe arbitrage is the wrong word there, but maybe a $400 or $500 scalp to recover the side of that spread. So what that did was take us from a situation where we had 6 of these spreads and our max profit was, X amount of dollars, to getting us in a position where we got out on the log leg, recovered, and our new max profit was X plus, that 420 that we were able to scalp right there. But with that said, when we got to this point, we called it out in our Discord server. We said, hey, if this thing breaks 455, we're probably going to see this 430 level. That's exactly what happened, right? It opened up on August the 11th, broke through that 455 level, shot straight down to 420, and that is where we exited. So would we have hit max profit on the trade? Absolutely, it looks like at this point, right? Because these expire this Friday. They wouldn't have expired yet. But we were in on a trade where it was flirting with our max loss price target. Within 24 to 48 hours, we were back down here at our targeted exit. We had profit on the table. We took it, and that one resulted in $809 of profit for us on the week. So we went from a trade where we were looking at a decent loss right around here to, managing part of that spread, remaining patient with our investment thesis related to that RSI. And then within 24 to 48 hours, we went from a trade where we were losing to one where we were able to exit for $809 of profit. So I was really happy with the way that one turned out. And then going down the list, these are a lot of just the smaller additions we had right here. JMIA, that one had some lackluster earnings. That created some volatility. It was potentially a little bit oversold after earnings. We could take a look at the chart and what we're looking at. There you go. You had this big drop from the 22-ish level down to about 20 a share. And we said, hey, let's get in on the 19, see if we could scalp some premium. We were able to sell them for 25 cents a pop with maybe 2-3 days until expiry. And it got a little bit close there on Friday at one point as it touched down at 1901. But, that's the reason we select these strikes. 19 was relatively safe if you try to take a look at where support lied. But with that said, we are in and out of that one. We let it expire for $250 in profit. And the next three trades we're going to talk about: ORPH, ZEV, and FULC. I'll highlight these so you know what we're talking about as we talk about them. These are our IV reversion strategy. So how does that work? If you are an HT Premium member, which if you're not, I would very much recommend you do, because it's a great deal. And we talk about all these trades and alert all of them, and you could sign up for that on our website, www.hourglass-trader.com. Aside from the shameless self-plug right there, the way that these all set up were the same type of strategy, right? We talk about diversity in stocks, but there's also a lot of importance when we talk about diversity of strategy. And that doesn't mean, option selling and then other option buying strategies. It means diversity in the ways that we deploy our option selling strategies. So while a lot of these generally revolve around the idea of the HT wheel, these three right here are a concept we like to play called IV reversion. So I guess getting back to the point that I started making about 30 seconds ago, what does that mean? Let's take a look at, let's do ORF, for example, ORPH. And if we take a look at the chart of that last week, I spelled it wrong. That was really impressive. This it looks crazy on the 180 day because of a huge short squeeze in the past. But you'll see it was trading right around this $4.20 range. And all of a sudden, there was a huge upwards spike. So what we see if we plot the implied volatility below the chart right here, implied volatility, there you go. You're going to see a huge upwards spike in implied volatility. And as we also see, when implied volatility comes up, implied volatility also slowly falls back down. So we have spikes like this on the run-ups, and then inevitable decreases in implied volatility. And what does that mean for the options that we sell? The answer to that is that when implied volatility spikes, so does the premiums on the put that we sell. And when implied volatility inevitably starts falling back down, that premium on the puts that we sold constricts, those options lose their value. And as we know as option sellers, when those options that we sell lose their value, we make money. So what happened with ORPH is we saw a spike up to the $5 level. And remember, it was trading at around $4.20 a piece before the spike. So taking a look at the option chain, we saw, okay, huge spike in IV. This is one that we've had on our watch list for a while. We're familiar with the price level. I mean, this isn't some super crazy biotech that used to be trading at like 3 cents and is now shot up. There's a decent long-term range and lower range right around the 5 level. So it's not surprising to see the price of that stock kind of slingshot back up to that level. So there was, not no downside risk, but maybe limited downside risk as opposed to another biotech company where the 180 day or the 1 year chart looks like an absolute mountain peak. But with that in mind, we knew it was trading around $4.20 a piece. It shot up to 5, so we took a look at the options chain. And we saw the 5 strike puts expiring this upcoming Friday. We're trading for 71 cents a piece, which is great because one, it was trading at about $5 when we entered into those. If it stayed at that $5 level, that area of longer term support, these were going to expire worthless. We were going to make a really decent amount of money on them. And even if it fell back down, right, where could you expect ORPH to stop if it started falling back down to earth? And the answer typically is right around that base it was forming before the spike at 425-ish, right? So if we took a look at the break-even price of the 5-strike puts that we were going to sell, we would know that that 5-strike minus 71 cents a premium would have given us a $4.29 break-even price, which is right around here, just above the red line that we drew. So not only are we, one, in a position where if it just holds these gains, we make max profit. Two, we're in a position where, if things turn against us and likely level back out down here, we're not losing any money at all. So the amount of risk that we have in this play is relatively low, and the value that we get on the options that we sold is derived from this spike in implied volatility. And we've got these other two plays that we highlighted right here, ZEV and FULC. We could take a look at ZEV because there was a super similar setup, right? We get this big spike in implied volatility because it jumped from $6.50 up to about $11 or $12 a share. And while admittedly the ORPH, the ORF, I guess if you want to pronounce the ticker like an acronym, the ORF jump wasn't really on news or anything, but rather just kind of a random spike. What happened with ZEV was they had news of a Berkshire Hathaway backed deal, which is generally positive news. So as far as our IV reversion strategy is concerned, if you have a stock that's trading in a decent range, right? So it's trading in the $6.50 to $7 range before it shoots up. You could assume that's, quote unquote, the value of the stock between $6.50 and $7. Now, when you have good news like a deal backed by Berkshire Hathaway, you could assume that that adds value to the stock. So instead of this prior range where it was $6.50 to $7, you could maybe assume it's at least worth maybe another 50 cents or $1 at the minimum, right? It jumped up pretty much $5-6 a share off the news, so the news could be that great. But as far as us being mindful of our downside risk and what we're going for here with this IV reversion strategy and taking advantage of these jumps in implied volatility, this is a relatively decently conservative estimate of where it could fall back down to. And again, from $12, $11, it would take a big fall to get back down to $7.50. But what we were able to do, thanks to the huge spike in implied volatility, was take a stock that was trading at $10 and $11 a share, sell a 7.5 strike put, and still get 20 cents of premium on it. So that's a really decent, I think maybe 2.5% return on risk on a stock that just needs to stay above this red line that we drew to make money. And it just needs to stay above that red line for the next 5 days until we get to that August 20th expiry. So that's kind of a good overall idea of what we're going for with this IV reversion type play. You put yourself in super high percentage opportunities because, look, it could keep jumping up from here. Really, I think at any given time, assuming RSI is relatively leveled out, it's kind of 50-50 on where a stock moves. You could have good news, you could have bad news, you could have a lot of buying, you could have a lot of selling, but the idea is that the probability or likelihood that it gets back down to this level is very, very small, and thanks to the increase in implied volatility, we're still able to, sell a decent chunk of premium at a largely unattainable price level for the stock to get back to. So we did that with ZEV, and FULC was one that worked even better, right? We talk about how even after these spikes, there's maybe a 50-50 chance of it going either way. Most of the time you're going to see some sort of reversion back. That's typical when you see a big spike. With FULC, we saw that big spike. We saw this run up in implied volatility. And when we got in at about, I think, this $18-ish level at the end of the day on August 10th. And what's crazy is that, this thing was trading at about $8.50 a piece. They had some good trial data, so theoretically, it's probably worth a little bit more than $8.50 a piece. What's crazy is we were able to get on a stock that jumped up to $18 a share, we were able to get 42 cents of premium on a 10-strike put. So that's going to stick us with a $9.58 break-even price, which is plotted by the red line. So again, as you know from what we've looked at here, as long as this stock didn't fall back down to the red line in the next 5 days, and that would take an over 50% drop at this point, we were going to hit max profit, which is just over 4% return on risk in a very short time period. This one offered some really nice leverage, so the return on capital on that was absolutely enormous. It was a really, really nice investment for us. And we get to this idea of IV crush, right? The blue line starts dropping off, that IV gets crushed, and it helped a little bit that the stock ran up a little bit further. But within a day or two of opening this, we were able to get out for something. We were able to get out for 10 cents on an option that we sold for 42 cents. And it still didn't expire for over a week. So we were able to pull a $960 profit on that in a super short time frame. And while ZEV is still open, similar deal, we sold this for 20 and it dropped down to 12 cents by the end of the week. That was $400 of profit. ORPH, ORF, it dropped a little bit on us, so we wanted to take the profit off the table. But all in all, those three trades where we set three price targets that were realistically pretty unattainable to get down to as far as our break-even price is concerned. Relatively low stress plays. We relied on IV reversion, and those three plays alone got us $1,600. So those have worked out very, very well for us over the past few weeks, and that's a strategy we're going to keep looking to go back to. I admittedly am a little bit slow in updating our trade performance tracker, but even before we got into some of these other IV reversion plays, we've already had 8 winners, no losers, and I think once I finally get the rest of these populated, we're going to be up to about 14 or 15 winners with no losers on the IV reversion strategy before we've updated to 8.69% average return. And again, super quick turnaround time on those with an average duration of a 1.66 weeks. Okay, deep breath. There you have it. We can get a little bit further down the list here. The last one I really want to talk about, APPH was another oversold earnings play, super similar to JMIA, but again, a quick one where that premium dies, and it dies really quickly when you have an IV dropping event like a earnings. So we were able to scalp $500 off that within the day, I believe. Now, the last one I really want to talk about was Wish, and this is a really good example of position sizing, setting decent break-even prices and being patient and using those position sizing and different steps of the HT wheel to help protect you when a trade turns south. So we started this off Thursday afternoon, and up to this point during the week, we were on fire. We had a really good week going. We were above a 2% return. We were cruising into Friday, and we thought, let's try to set up a trade where if it expires worthless, we could scalp out about $400. But as so many of you have probably heard before, there's no such thing as free or even easy money in the market. So that one did not quite go to plan, but let's talk about what happened and how we managed the trade. So, no need to bury the lead here. When we pull the chart up, you could see exactly what happened, right? We sold 8 strike puts. We talked last week on the stream about how we thought that 8 level was going to be a decent number, because if we zoom it out a little bit, there's a little bit of chop going on back here in the in the 8 to 850 level. So we figured maybe that would act as a little bit of a downside cushion if they had some negative earnings. And their earnings came out and they were very, very bad, to be quite honest. So that is why you see a huge move in excess of the expected move on that stock. The way that the options were priced, the expected move was down to $8, so it outpaced the expected move, went in the wrong direction for us. So the kind of double whammy right there, and really the one area that would put us in some hot water off the bat. So we sold the 8 strike puts for 20 cents. Our break-even price was going to be $7.80. Let's see. Let's plot it right there. Oh, got to click again. $7.80 was going to be our break-even price. Let's get this drawing out of here. So as we could see, very, very quickly, that thing dropped below $7.80. And we were in a position, we were losing about $2,000 at open. But as we know, that initial play, that those 28 strike puts that we sold off the bat were really only part one of the trade. Part two of the HT wheel is going to be to further increase that position. And we did so by selling 6.5 strike puts for 22 cents a piece. So individually on that leg, we had a break-even price of about 28. That sounds right. 22 cents a premium on a 6.5 strike put. But the second leg had a break-even price of here and a max profit point of here. So at the very least, even though this thing, when we woke up and the market was opening, was at about 6.85, meaning this was at about a $2,000 loss, we were still able to get in a position where we said, hey, we're going to increase our position, scale into part two of the HT wheel, and sell an equal amount of cash secured puts at a lower strike for 22 cents a piece. And we know that if we sell these at a 1-to-1 ratio, meaning that we had 20 cash secured puts up front, we sell 20 more cash secured puts, then the premium that we sell right here is going to be a cent for cent reduction in our overall break-even price. So just that morning, by scaling further in, we were able to drop our break-even price from the original $7.80 that we plotted right here down to $7.58 off the bat. So we could remove this line. Maybe we'll keep it in there to show the progression of our break-even price. So with one move that morning, we moved it from here down to here. And then again, that accomplishes our goal of slowly dropping that break-even price, slowly getting it to fall back to where the stock is trading. And, we could lower that break-even price week after week after week. The stock isn't going to go down forever. And as we saw, the stock didn't go down for forever. It opened up at about 680, enough time for us to open these cash secured puts. And throughout the day, it bounced back up, almost getting back up to $8 at one point. And I think right around this spike is when we said, hey, if we see any opportunity at all to get out of this trade, look, Wish is down 20% on the day, overnight on a trade, and we were in hot water about 4 hours ago. So if we saw any opportunity at all to get out of the trade, we were going to take it. And that break-even price for us was going to be if we were able to get out of these 8-strike puts for about 40 cents or less. So that's exactly what we did. Wish spiked back up. We were able to get out for a 39-cent debit on these things, which on that first leg results in a $380 loss. But thanks to following the steps that we have laid out in the HT wheel, we were able to add this second leg, which made us $440. And despite a 20% drop on Wish post earnings, a negative move against us on something that was far outside the expected move, terrible earnings, and we still were able to come out with a $60 profit overall despite that huge drop in the stock. And if there's really one clear example from the last week that I could point to emphasize the value of the strategies that we're putting into play right here, it's going to be that trade with Wish, where we thought, oh man, we've got a huge loser on our hands. Let's just trust the process that we have laid out, not get too emotional in the trade. Don't get caught up with the fact that we're sitting on a big loss when this opened up, but play the numbers game, wait for some mean reversion. What goes down, at least sometimes comes back up. That's even the worst stocks can have those dead cat bounces sometimes. So that's what we were aiming for. That's what we got, and eventually we were able to pull a profit out. But with that said, that pretty much wraps up what we did last week. It was a really awesome week for us. I know a lot of those of you who were following along with our trade alerts also had a very nice week, and I think we heard about it, so always happy. It's always more fun when all of us win together as opposed to me just sitting up here, so that's why it's fun when we get on the same trades, because it doesn't cost us any money to all win together. We could all get into the same trades, and we could all come out on top on a week-to-week basis the way that we have lately. To make a quick point, if you take a look back at our weekly profit, we haven't had more than 3 weeks in a row where we've made money. With us making money on last week, the week of August the 8th, that gets us to 4 weeks in a row of profit, which is a record profit streak on a weekly basis. Even going back to last year when we tracked, we only hit a max of 3 in a row last year as well. So nice to finally break that little limit, and we're hopefully going to keep moving upwards with what we've got set up for next week. And one of my favorite things that I do at the beginning of each week after I've rolled my positions forward in the profit tracker to evaluate how well positioned we are to make money in the upcoming week, is hypothetically go through what would happen if stocks stayed relatively flat. So for UWMC, they have earnings coming up Monday. We know from what we were looking at with the price after hours on Friday, it would take a decent drop. It would take a 50-cent drop for these to be in the money. So we could assume that if it trades flat or relatively red, or slightly red that is, it's still going to expire worthless. So we could put a 0 in there. Corsair, these are going to expire worthless no matter what. The only thing they could do is cap the gains on the shares. So that's another 0. And, we don't know if something's going to go up. We don't know if something's going to go down. The most likely scenario is that it, stays relatively near the price that it is right now. So this would result in an 87-cent premium, meaning we make a little money there. BBIG, if it stayed at 289, again with that same assumption, these would expire worthless. These would expire worthless. And then Clover Health, SOL, FFIE, ZEV, these are all trading above where they are. So realistically, is one of these probably not going to make max profit? Yes, but they're still trading above that max profit point. But what I'm emphasizing right now is that as long as the market stays perfectly flat, which isn't going to happen, but is a good way to evaluate your trades, because it could trade relatively flat, or things could go up in your favor and you wouldn't need to worry about any of these. You'll lose no sleep during the week. But if things stay perfectly flat, we're going to collect $4,000 in profit or a 2.68% return. So I think at least off the bat, we are extremely well positioned to have a very, very good week for this upcoming week in the market. And that's not to mention that, if Corsair jumps back up to 27.50, that's going to be another $1,000 that we could add on to that estimate. If UWMC knocks earnings out and the 7.5 strike puts that we sold with December expiries drop down to 0.8, that's another $1,000 we have right there. So we've got all these plays going. This is why we love having the diversity of our portfolio so much, because with these trades, we've always got something going in the background where, if one thing isn't doing too well, another one could take off and completely cover up the losses from that. For example, all of our new trades that we opened last week made us a really good amount of money and covered up some of the losses that we had from Corsair and led us to a really nice week. But with that said, let's talk about what we're looking at for the upcoming week. This, I think we've talked about a decent amount, the BBIG trade. We talked about Corsair earlier. I think we're going to continue that strangle that we're currently in. BBIG, the way this is set up, there's been so much premium on these things that we got in on this trade on June 30th when the stock was trading at $379. Objectively, another one that has had a huge drop against us, because if it doesn't drop hard or even is green, God willing, we get really easy profit overnight and we never have to think about it ever again. But this thing has dropped almost 25% on us. However, we're still in an overall profitable position because of these option selling strategies and trades that we have put into play for this to get our break-even price down to $263 for this upcoming Friday. So where I stand with this one is, what do I want to do going forward, right? If it finishes right where it is at $289, we're still going to have these shares. The calls are going to expire worthless. The cash secured puts that we sold are also going to expire worthless. We'll be up overall in the trade with the $263 break-even price. But is that premium still good enough? I mean, I guess in short, the question is, do we want to close it out and just take the $364 profit and head to another trade? Or do we want to keep it rolling because the premium looks nice? And that is something I'm going to figure out right this second. So if we take a look out to September, we could really do the same exact thing that we did in August, right? Where our strangle is selling a 3-strike call and selling a 2.5 put. And what that would do is get us about 35 cents of premium on the call and about 20 cents of premium on the put for 55 cents overall of premium. And we know that that would be a cent for cent reduction, meaning a 55-cent reduction in our break-even price, and get us down to a 208 break-even, which is really, really, really solid. And shout out to OLSKHUU. I don't know if I would even begin to try to pronounce that all as one word, but appreciate you checking in and bringing some friends for the Sunday night stream. But back to the point we're making about BBIG. We are kind of in the driver's seat. So often when we're thinking about should we roll forward our strangles, the question is, how quickly can we drive down our break-even price? Because like with something like Corsair that we were looking at earlier, it's because we're sitting on a loss. With BBIG, when we're getting to this decision, we're sitting on a gain. Instead of maybe selling the 3-strike call, we could get a little bit more aggressive. We could maybe go out and sell the 4-strike call. And that is some very valuable information, knowing that that's supposed to be pronounced old school. So that has saved me a lot of embarrassment pronunciation wise on the stream. So appreciate it, old school. But with that said, getting back to the point here, instead of maybe selling a 3-strike call, again, remembering because we're in the driver's seat since we're up on this, we could maybe stretch it out to a 4-strike call that we could sell for 25 cents a piece, sacrificing maybe 15 or 16 cents a premium, meaning our break-even would be only 2.2 here. But again, that's a really decent downside cushion. And the great part about that is it gives us upside to $4 a share on what we own right here. So, honestly, I don't want to model this out too much because I want to wait until Friday when I actually make the trade. But I'm really leaning towards, getting back into these 2.5 strike puts and then selling a 4-strike call, because when you look decently out of the money here, there is a lot of premium for how far out of the money these options are. And we want to take advantage of that. We don't want to just take a ton of premium at 3 just because it's right there. When we're in the driver's seat like this, we could get a little bit aggressive. And I say aggressive, but in reality, right, we're still driving our break-even price down another 40 cents with what we call a quote-unquote aggressive play. So despite being aggressive, it's still pretty damn safe, since we are at a position where we've dropped a break-even price on a stock we entered at $379 down to 2.2 in roughly the span of 2 months. So if that is something we can do in the span of 2 months, imagine what would happen if we keep holding on to these shares, keep selling something decently out of the money, where our break-even price could be maybe by year end. Could it be down at 0 and this is essentially a risk-free trade at that point. The other thing that's really important to think about when you're setting something up like this is the intervals of the strikes of the options. We have a lot of flexibility here on BBIG, not so much because they're monthlies, and we would really have a lot of flexibility if they were weekly options. But the great part about BBIG is that they have options every 50 cents. And what do I mean by that, right? You see an option strike at 1, 1, 5, 2, 2, 5, 3. So we have flexibility in deciding, hey, do we want to get super conservative and sell 3 strike calls, or do we want to get a little more aggressive and bump it up to 4 or 450? And a lot of stocks don't have that luxury. One example is Visalink, which we are holding at the bottom of our portfolio and is a slight loser right now, so we're trying to work on that a little bit. But, the issue with Visalink is that the option strikes are 2.5, 5, and 7.5. In addition to them being monthly, there really isn't a lot of flexibility. So if the stock starts getting away from you the way that it has with this one and it's down to 2, you don't really have a lot of recourse, because all you can do here is sell 2.5 strike calls, which are decently out of the money. And then on the put side, what are you going to do? There's not the option for you to sell a cash secured put that's out of the money. You have to go in the money with the cash secured put that you sell. So you get to be in a little bit of hot water there when you don't have these tighter option strikes that you could utilize like we saw with BBIG. So that's something that's been working very, very nice for us, and is a reason why when we take a look back at BBIG's option chain, why we're probably going to keep that trade going with an aggressive call strike and maybe a little bit more conservative on the put side, collecting 20-25 cents a piece on some 2.5 strike puts that we're planning on selling moving forward. So that's the plan with that one. Clover Health, we could talk about this one really quickly because this has been up, it's been down, it's been up, it's been down. But if you take a look at our trade history over the past few weeks, I think it's been a few weeks since we've been on one, but we love hitting these Clover 8-strike puts, right? We hit them back the week of July 26th. We hit 8 and 9s the week before that. And, we hit a couple more before that as well. And all in all, those got us about $1,000 of profit. So anytime Clover gets back down around that $8 level, we are perfectly happy to go back in there and start selling those 8-strike puts again. And let's pull the chart up. We could take a little bit of a look. And again, for those of you who are in the chat watching, appreciate you joining us again on this Sunday night for our stock market scan. The way we typically do it is we go through, we do a weekly recap. We're already through that part. And then we go talk a little bit about what we're holding for this upcoming week. And if you guys have a stock that you're curious about or you would like to look at through the perspective of an option selling strategy, feel free to throw those into the chat and we could throw them on a little list right here and get through them as we move through the stream. But back to the point we were talking about with Clover Health is every time this thing gets back around the $8 level, there's usually a pretty decent jump. So if we zoom out a little bit to the 180-day, we always want to have that downside in mind, because if we take a look at where it could really, really get down to, there's a little bit of support down at 7. But, if we sell an 8-strike put and we get 30 cents a premium the way that we did right here, right? If you see the... Where'd it go? The 8-strike put, we got 31 cents a premium. So off the bat, even though we know that potentially this thing could get down to 7 a share, what we know is that if we sell an 8-strike put for 31 cents a premium, we're going to have a $7.69 break-even price on there. So if we go to the 1-month chart, we chart that $7.69 break-even price. The trade starts to look pretty good on a 1-month basis, right? This is the 20-day chart we're looking at. These are the last trading month for Clover Health. And the trade that we have set up this week is an 8-strike put expiring on August 20th, this Friday, meaning as long as Clover stays above $7.69, this line that we've drawn this Friday, and again, that's a price that really hasn't been down at this entire month, we're going to make money on the trade overall. So that just gets back to the point of the strategy that we're trying to put in play with these option selling techniques, where we give ourselves high percentage plays and we still get really nice returns on this, right? Because if you take a look at, let's go back to the option chain right here. ROR is going to be the single best way that we evaluate the return on an option that we're getting, right? And even fully cash secured, these 8-strike puts are offering a 4.64% weekly return. For those of you who have been following along with us, you know how impressive of a weekly return that is. And for those of you who have not, it compounds very, very, very quickly. So if you come from an option buying background, you might say something like, hey, a 4% return in a week, this really isn't that impressive. But if you kind of flip the script here and think through the lens of an option seller, what happens with an 8-strike put, right? If this finishes above 8, we're going to get a 4.64% return. And it looks pretty likely that 1, we're going to finish above 8. So 2, if it doesn't finish above 8, then what happens? As long as it finishes above the red line, we're still making money. It might not be that 4.64%, but any trade we're making money on, we are happy with that trade because you're never going to go broke if you're taking a profit like this. So let's see, we got a question from Chris W in the YouTube chat. So if you got assigned and the price is at 780 and didn't want to hold shares, would you still profit if you sold at 780? Great question. So if it gets down to 780 right here, what do we know about the 8-strike put? We sold it for 31 cents, meaning someone gave us $31 per contract that we sold. If it gets to 780, how much is that thing going to be worth come Friday at expiration? The answer is 8 minus 7.8, so 0.2. We sold it for 0.31. It's now worth 0.2 hypothetically if it gets down to 780. So from that point, the difference in the 0.31 that we sold it for and the 0.2 that it's now worth is 11 cents. And as we know, options contracts are for 100 shares. So it's an $11 profit per contract that we sold. So you could have a 40-cent drop from here. And just to kind of help conceptualize just how big of a drop this would be, a 40-cent drop divided by 822, the closing price, would be almost a 5% drop next week down to 780, and we would still make money. We'd get $11 per contract that we sold, which is roughly 33% of the potential max profit that we had set up on that play. So another great example of one where we've identified a level of support right at 8. I mean, if we draw the line at 8 here, we can see Clover's pretty clearly bouncing off this level. But again, it's always important to be mindful of that downside risk. If it breaks through 8, we're still protected down to 769. And if it goes down to 769 or below that, we could take assignment of the shares with the 769 basis, look forward to the next week, sell a covered call for 30, 40 cents and lower that basis by 30 or 40 cents and get things down near 720, 730 a share, and repeat on a weekly basis. Because, I mean, provided something doesn't happen overnight that sends this thing down to 0, you're going to have the opportunity to make your money back at some point, whether it's this week, next week, the week after. That's just the way that the wheel that we run operates. You might be losing now, but we like to refer to all of our losses as temporary losses in here due to how easy it is with these premium these premium opportunities that we identify to make your money back. Moving on to the next one, super similar idea. We often open these in tandem because I feel like they're always hitting our targets at roughly the same time. So SOL is another ticker that is all over the place. Super volatile, right? It's been bumping from 656 all the way up to 789 just in the past trading month. If you back it up to the 180-day, I mean, it's coming off the back end of a huge run. So we're expecting it to settle out in this level right around here. So even if we are assigned, we're happy to get in on it. Definitely a lot of potential upside on this one, but the amount of volatility, the up and down movement that we see, especially in the past month, creates some decent premiums in the options that we could sell. So with that said, we were able to sell some 6.5 strike puts. We tried to get 15 cents. I think, yeah, there you go. We got filled at 14 cents a piece. But point being here is, again, we could draw the red lines on the chart and see how solid it looks. Let's get these out of here because these are old drawings. Remove drawing. We have to zoom out on the y-axis because this thing is so far down here. So as long as for the next 5 trading days, expiry is this Friday, August 20th, if it stays above 650, we're going to hit max profit. And max profit for us on this is $210. So there's a really decent chance that we're going to bag $210 if this thing stays above 650. But again, what if it drops below 650? That's okay too, because we got 14 cents of premium. 14 cents of premium minus the 650 strike means we have a 636 break-even price. So if we drop down to 636, that's our break-even. So this is our max profit line. This is our break-even price. Anything above the bottom red line here on the next week, the next 5 trading days, we're making money. So you take a look at that at SOL, you take a look at it at CLOV, and again, these are 2 really nice setups with high probabilities of profit. And if these work out the way that we think they will, and we're able to get max profit on both, we are bagging, just off those 2, that's going to be $830 in profit, which is my rent money for the month, damn near. So that is the kind of high probability, low stress plays that we look into with the strategy that we're running. Continuing the loop right here, FFIE is the third new play that we added on Friday for this upcoming week. Really similar idea. It's a former SPAC, so if we zoom out on the chart, we know what that's going to look like, right? And we're not going to see it when we zoom out on the chart. A little bit of a brain fart right there because they changed their tickers, so we're only going to see it post-merger. But for the SPAC that it used to be, it had a $10 net asset value. So that's something we expect to see as a potential level of support. And post-merger, it can potentially drop below 10, but 10 is a decent level of support in the market. Excuse me, not in the market, but for this stock in general. So what we were able to do, again, we sold a 10-strike put for 30 cents a premium. Another one where we have to zoom out on the y-axis just to get down to our max profit point. And we sold that 10-strike put for 30 cents a premium, 10 strike minus 30 cents a premium, $9.70 break-even price. And, after doing 3 of these live right here, hopefully you guys are starting to get the point of what we're going for. Another setup with a high probability of profit, high probability of max profit, and even further cushion for that break-even price level. So again, FFIE, SOL, take a look at the red lines. We got to zoom out to see them. CLOV, take a look at the red lines. We have 3 really nice similar setups, and if all 3 of these finish above those red lines that we drew, there you go. That's 1280 of profit right there. 1280 of high probability, low effort, low stress profit. It took us maybe 30 seconds to put the orders for these trades in, and then we just let them sit for the week. That's the other awesome part about this strategy. Interesting question, to say the least, from Jackie977. Shout out to Jackie for tuning in and joining in the chat. But the question was, do we think Afghanistan is going to have an effect on the market tomorrow? Largely, I would say probably not. What we can see right here are probably the best indicator of how the market is going to perform is taking a look at the futures. We have /ES, which is the S&P 500 futures, and they're down about 0.25%. So if there were really going to be some dramatic move in the market based off what's going on in Afghanistan, we would see it right here in a 0.25% downward move at this point of the night. Well, I mean, it's not tiny. You're going to see some stocks pull back if that holds. It's nothing too crazy and nothing catastrophic to the point where I would be concerned about any of your investments based upon what's going on over there. What does tend to happen when war-like news is hitting the mainstreams is a lot of these war-type stocks like Raytheon, which may be RTX if I remember correctly. There it is, Raytheon. This might go up because this is one of those government contract type stocks. Maybe that might be a good one to keep an eye on. But other than that, as far as the overall market and what we're playing on a week-to-week basis, I'm not terribly concerned about what's going on in Afghanistan having an impact on what we are doing. We are coming up to the hour mark on the stream. We've gotten through these. VisaLink, we talked about it a little bit. We're just holding that one to see what happens. They've got earnings this week, and if it jumps back up, it jumps back up. But otherwise, we're going to write that one off as a loss. IGC is an interesting one here that we're going to talk about really quickly, and then we're going to get to KB's suggestion in the YouTube chat. So we're going to throw our upcoming list up here. And we've got RBLX because they have earnings tomorrow, and we will take a look at that in just a second. But for now, we are going to talk about IGC and what we're going to do about that one because I know we had some people follow us into this one. This is already kind of my plotted move right here, so maybe ignore these 2 rows. But we will talk about this after I take a quick sip of my water because I think I've been talking for a little bit of time in the corner of my bedroom. My voice is getting a little hoarse, so I need a little water. All right, and we are ready to jump into it. So with IGC, what happened is, quite honestly, it was another similar situation to what we had when we talked a little bit earlier about our IV reversion strategy. And again, we got another comment in the YouTube chat about that, asking if Afghan is going to be a black swan event. Shout out to the counselor for the follow on Twitch. But again, that question in the chat, is Afghan going to be a black swan event? I would say absolutely not at this point because, as we could see, futures only down 0.25%. Back when we were having those drops in, February, March, April of 2020 with the COVID crash, I mean, these things were almost 3 or 4% down at night, and that's when we saw a big event in the market. what's going on in Afghanistan really is not going to have too big of an overall impact. Obviously, it's unfortunate what's going on, but in the context of what we're talking about, it really shouldn't be too large of a consideration. So back into IGC, a similar idea, right? We saw this spike in implied volatility when it jumped up to 465 on good news. We saw that it was trading in the 150-ish range, so presumably with good news, a stock that was trading formerly at 150 should be worth a little bit more than 150. And, it's trading at a little bit more than 150 right now, unfortunately. It didn't quite hold the 190 level that we had, but no problem because, like we mentioned a second ago, when we were talking about CLOV or any of those stocks that could potentially move against us, we could continue to drop our break-even price week after week or month after month. The stock isn't going to go down forever. So let's see how we're going to do that. What we did off the bat was we sold 2.5 strike puts and 2 strike puts for 42 cents and 25 cents of premium, respectively. So what happened there was we had this initial break-even price of 208 off the 2.5 strike puts because that's the 2.5 strike minus 42 cents of premium, yada, 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 208. And then we further added these 2 strike puts, and overall that put our break-even price at 192. So IGC is no longer at 192, as you can see. So let me put this right here. This is the loss that we're currently sitting on, right? We've got a $610 loss. We had about $4,000 of capital invested, so it's roughly a 15% loss off the bat. Obviously nothing to sneeze at because that's 15% a decent loss, but here's the good news. Here is how we are going to try to save this. So at the very least, we're going to take assignment. We're going to double our position because that is the way that the HT wheel works. Those are the steps that we're going to go through. Step 1 was creating the position, and we always want to be mindful not to use 100% of the capital that we're comfortable with allocating to a trade off the bat and kind of, taking away that flexibility on the back end in case something moves against us. This one has dropped 58% against us in less than a month, so having that buying power flexibility on the back end of this year is what's really going to help us. But long story short, stock has dropped almost 60%. We had 4,000 invested. 610 loss is what we're sitting on right now for a minus 15% return on capital. Step 1 was setting this up. Our plan is to take assignment of all 2,000 shares. So assignment at 250 and assignment at 2 equally is going to equal a 225 basis in the stock that is now trading at 161 for a 1280 loss on the shares. But remember, we get the premium on the puts that we sold no matter what, regardless of assignment. So that's how we get to that 610 loss. So we still have a 192 break-even price. So what are our options here? As we mentioned, with the process that we follow with the HT wheel, step 1 is going to be to increase your position. So we're going to go from 4,000 invested to 8,000 invested. And if you're watching along or have a smaller account, don't let these numbers scare you. I mean, we did this with 2,000 shares. You could have entered into this one for as little as $200. So I think what's important to pay attention to up here is the percentage return because that's going to be the same for everyone regardless of account size. But with that said, we're going to double that initial investment, and we're going to do so by selling more cash secured puts at 1.5 strike. And if we take a look at what's coming up for September, it looks like we'll be able to get between 15 and 20 cents of premium on those. So we're going to call it 17 cents of premium. And as we mentioned a little bit earlier, we know that when we sell these at a 1-to-1 ratio, meaning we had 20 puts up front and we sell 20 more, this 17 cents is going to be a cent for cent reduction in our cost basis, meaning our new break-even price is going to be $1.75 from the cash secured puts that we had right here. So that's good and well. We've got it down to $1.75, but our break-even price, but the stock price is 161. So we're still in a position where we would be at a loss. So what do we do now? We have these 2,000 shares. Let's sell some covered calls on them. And if we look at the 2 strike calls, again, we could get between 15 and 20 cents of premium on those. So we'll conservatively call that about 17 cents. So with the covered calls that we're selling, we would get another 17 cents of premium, and I just totally messed that up, minus 0.17, which gets our break-even price, CC, for the covered calls. Our break-even price would then be down to $1.58, which successfully has put us below the current stock price of $1.51. So what's great about this is, as long as this finishes above 150, that's going to hit max profit. We're getting the premium on this no matter what, so there's another 340. And if IGC stays at 161, there you go. We've turned a profit of, albeit less than 1%, but we've turned a profit on a trade where the stock has dropped 60% on us. And what's great is that, IGC is a pretty volatile stock. It's relatively oversold in the recent month. If this thing jumps back up to 2, we're now sitting on a 10.6% return, an $850 return for us on a position where still the stock decreased 50%. So what's great about this, obviously, is the fact that it's moved so sharply against us, yet we still have some sort of recourse to recoup that initial investment and not totally get boned by a stock that has dropped a huge amount on us in a short period of time. But, when stocks do move against us like this, our number one goal is to play defense. So with this 2-strike call, we get 17 cents of premium. Yeah, that gives us a $1.58 break-even price, but I think we could do a little bit better on the break-even price. So what if we change this from a 2-strike call to a 1.5-strike call? What we know off the bat is that would cap our stock gains at $1.50. So these would get called away for a $1.50, a $1,500 loss no matter what. But being closer in the money, we'd be able to get more premium on the $1.50 strike calls, that is. So we'd get, instead of between 15 and 20 cents for the 2-strike call, we'd be able to get between 25 and 30 cents for the 1.5 strike calls, which is, we'll call it 27 cents. So if this becomes 27 cents a premium, we're now in a position where instead of decreasing it by 17 cents, we now decrease it by 27 cents. And we now have a 148 break-even price. Now, this is where you have to kind of balance, the risk versus reward profile here. Because at this point, the most we can make on this is if IGC finishes above $1.50, we get our shares called away for $1.50, the puts expire worthless, and we collect that call premium no matter what, and we're sitting on a $50 gain. Is that the best thing in the world? Because, if this thing finishes at $1.50, it's dropped 60% on us and we're still making a tiny bit of money. Or is it better to say, at least for the next month, let's operate with the 2-strike calls, because now we're in a position where even though our break even goes from $1.48 up to $1.58 and we lose 10 cents of protection, the good part here is that this becomes a 2-strike call. This drops to 17 cents a premium. But we give ourselves this upside to come out alive with, if I update this as well, with an $850 profit, aka a 10% return. So because of the lack of upside a 1.5 strike call would get us, and again, kind of alluding back to our BBIG conversation earlier, there's a lot of flexibility with the 50-cent interval on option strikes. I'm partial to still leaving some upside on this with the 2-strike calls, working with the $1.58 break-even price for the next month until September, and then doing the whole thing over again, right? Just remembering that just on this Friday, we're going to go from a 192 to a 158 break-even price, meaning that we've decreased our break-even price by 34 cents in 1 month. So, it's not unreasonable to think that even if we're getting aggressive right now and going with the 158 break-even price to give ourselves upside to 2, that comes September 17th upon expiry, there's no reason we can't do the same thing with November, lower it another 30 cents, and then we're really cruising with a $1.10 or a $1.20 break-even price headed into the back end of 2021. So that's what I'm going to do for now. My plan is to go, double down by selling cash secured puts at a 1.5 strike, cover the shares that we're going to be assigned at a 2 strike, and then just keep the train moving with a much better break-even price moving forward into September. And then come September 17th, we'll reevaluate from there. So again, another really good example of how even though we played a stock that was a little bit on the riskier side, we identified an opportunity where there was some really nice option premium on what we were selling. And thanks to that option premium, we were able to enter on July 22nd, less than a month ago, on a stock at $3.88. The stock is now trading at $1.61, and we still have a pretty decent path to profitability thanks to these option selling strategies that we have deployed. So if we never lose a trade, we're going to make a lot of money. So the goal is to, win every single trade. Sometimes we're going to have to cut some losers like we're going to do with Visalink. But in general, with what we are doing, we are going to win far more often than we lose. We pop over to our year-to-date summary, our trade performance. We have a roughly 90% win rate on the year with an average return of 6.06%. So it's all about, limiting the losers. And it's okay to have, smaller losers, but what we really want to eliminate are the ones that we see right here where we lost like $6,000, $5,000, $5,000. That is the kind of stuff we want to eliminate, which is why it's okay sometimes to cut losers like we're about to do with Visalink for a little bit of a smaller loss, because in the end, the amount of winners are far going to outnumber the amount of losers. Our biggest job is to make sure that the losers aren't just enormous numbers, and by doing what we did with IGC, continuing to lower that break-even price, that helps make sure of that. So with that said, we're like an hour and 10 into this, and I've finally gotten through both the recap and what we have for the upcoming week. So let's take a look. We only had one request tonight, but it was for Roblox RBLX. They have earnings tomorrow. Let's take a look at what we're seeing. So I remember this thing IPO'd pretty recently. Not recently as in like the last month, but I remember there it is. Back in March is when this thing IPO'd right at around, it looks like, I mean, it IPO'd at 60, jumped up and traded in the, 65 to 80-ish range for a little bit of time before breaking out over 100, falling back to 75 and getting back to 84 as of market close on Friday. That's some pretty big range right there, to be completely honest with you. So with their earnings coming up on Monday, I'm assuming after hours, let's take a look at our typical process for evaluating stocks during earnings. We always want to choose the nearest expiry, and we want to choose strikes that are on the outside edge of the expected move, which is this MMM yellow number that we see right here. So let's bring up our handy dandy Windows system calculator to figure out where that's going to be, right? So with the closing price of 83.96 cents, there's an expected move of $8.96 in the upcoming week. So if we subtract 8.96, that's going to give us the lower end of the expected range right at 75. So we could plot that on there with this red line. And then if we want to get the upwards side of the expected range, we could take that 83.96 closing price, 96 closing price, add that 8.96 expected move, and see that 92.92 is going to be, the top end of the expected range. And, that's not to say that it can't go past that, because like we saw with Wish, it definitely went past the expected move. But in general, using this concept of the expected move is going to be a really nice way to plot out areas to sell your options so that you put yourself in the highest probability trades and really get the numbers working in your favor. But what we see, or I guess what we like to look for starters when we plot these out, is, are these numbers running into areas of support? Are they running into areas of resistance? And we are seeing that a little bit, right? 75 looks like it bounced off back in July 19th. It dipped below, but quickly bounced back up on July 27th. And then we had an ultimate bounce on August the 3rd as it ran away from that number. It's the 92.92 resistance level looked like it came into play back at the end of June. So, there's a little bit of precedent for both support at the lower end of the expected range and resistance at the upper end of the expected range. So, decent idea here. I don't know if you're looking to make a bullish play on this. I don't know if you're looking to be bearish or if you're looking to do something like an iron condor right here. But this is one I expect to do pretty well based off the limited amount of things that I've read about this online. I think the revenue is probably going to be looking pretty damn good. So I would skew, lean towards selling something in the 75 strike range. Let's back this out and see what kind of premium we can get on this. So yeah, right around 75, you could get a 2.07% return, which is a really, really nice number for the bottom end of the expected move. If we really want to be mindful of our potential risk, the bottom support looks to be 65, and you could, get a tiny bit of premium there. It's really not worth it at all. Looks like decent margin requirements on this one though, right? So if we wanted to sell a 75 strike put using that idea of the expected move, we know that normally it would take $7,500 to sell one of these, but it looks like it only takes 780 of collateral if you're using margin. So that becomes a $150 return divided by 780 of collateral to get you a 19.2% return on your investment on this one, and that's just provided that it stays above 75. So it could kill earnings, go up. It could, not do great and just hover around the 75 area, and you'll still hit max profit on this, and your break even is roughly 73.50. So honestly, not a really bad place to be at that 75 strike put. I do not hate that idea at all. I will just caution you that if you are someone who's going to be using leverage on something like this,
Again, just be very mindful of that overall potential max loss. Don't load up 10 of these contracts and say, hey, this is only going to take $7,800 of buying power. Then all of a sudden this thing completely tanks and you're sitting with the $73,000 position you can't afford. So while it is always nice to use margin because it frees up cash for other trades, never put yourself in a position where if you're assigned on everything, you're just not going to be able to afford it, because if there is a big black swan type event or we see a decent market pullback, you are going to be in a lot of trouble. And our number one goal is protecting our capital, living to trade another day. So with that in mind, we've got one more request as I take another quick break for a sip of water. All right, time to kill that 10 seconds of dead air on the stream. So we got another request from Rich H in the YouTube chat. Appreciate you watching with us on Sunday night and participating in the chat. Let's take a look at SPRT. So this is Support Calm. I think I've seen this mentioned on social media. Don't know too much about it. Let me throw it in here to see if we have any upcoming events. SPRT. And there you have it. And shout out to Fairy Sprite for the follow on Twitch. I always love hearing that notification noise. Looks like we already had earnings on SPRT, so nothing too crazy coming up on it. First glance, we see decent flexibility that we like to talk about on these strikes, but the fact that there's a lot of 50-cent intervals and then not 50-cent intervals up here leads me to believe this thing has spiked a ton lately, and there we have it. So, number one, first impression when I take a look at this chart is it's really just not a setup that we like to target with our strategy, right? Because if something can run from $1.78 back in March up to 10 or 11 a share in the blink of an eye, that means it could also fall back down to this $4, $3, or $2 level in the blink of an eye as well. And when something happens that quickly, a lot of the strategies that we put into play regarding, basis management and continuing to lower your break-even price, they're kind of ineffective because we're not able to lower our break-even price as quickly as the stock is dropping against us. And there's some serious premium on these on a week-to-week basis. But what's almost more interesting to me is if you go out on a monthly basis, right? Because look, at 8, if you wanted to get in on this, it's probably not that manageable if you're playing around the money and it drops down to 4. But with that in mind, what if you started your trade at about 4? So if we take a look out at September, because August there's really no premium down around these levels, but if you take a look out at September, you're starting to see some premiums in that $4-3 level that you potentially could take advantage of. Let's take a look at the volume really quickly to make sure people are trading these things, and absolutely there's tons of them. So what you could do is, instead of getting risky and starting up here and worrying about a drop down to here, is start your trade off right here by selling a 4-strike put for September off the bat. And what we know is that's a 4.58% return in a month, which is a really solid return for a month. And let's see if they offer any. Oh, they offer a ton of help in the margin department. So this is what we really like to see with something like this, right? Because this is probably my single favorite use of margin in your account, because we don't want to completely over leverage in something that expires in a week, but if we want to make a more conservative play that expires in a month, I also don't want to tie up the full cash secured amount in my account, because that restricts me from making other plays. Where margin is great is in an opportunity like this, where you want to have a play that's sitting in the background for maybe a month or so, and it's only taking up a little bit of money. And in this situation, if you wanted to sell 10 of these, it would take about $3,800 of premium. But if you wanted to use margin, it would only take $500. So you'd have about $3,300 of cash freed up for use during the month using these margin privileges. And again, that's not to say that, I'm going to, since I could have afforded a $4,000 position, I'm going to put a leveraged $4,000 position in. Don't do that. But, use that margin requirement and that leverage to help free up that cash for other plays throughout the next 4 weeks. But with that said, the 4.58% return is derived from this premium between 15 and 20 cents on a 4-strike put. If we get that same premium, even on the low end, 15 cents, and get $150 off $500 of premium, you now have a play that pays out a 30% return on capital over the next month, which is a very, very, very solid trade and gives you a break-even price of about $3.80. So if this trade finishes above this red line that we've drawn right here, come September 17th, this is going to hit max profit. You're going to get a 30% return on capital. If you choose to go the cash secured route, you're going to get a 5% return on risk, which again is still a decent number for a 1 month trade. And the only thing that makes me a little bit hesitant is potentially getting stuck with something at 385 and then seeing it again drop down to this 2 level. So with that in mind, we definitely want to keep the position sizing aspect of our HT wheel strategy in mind, because if we drop down to 3, we want to have that cash on hand available to double down on the trade and further drive that break-even price down. So honestly, I'm a fan of the Roblox 75 strike puts we just talked about, and I think I'm a fan starting to sell myself on these 4-strike SPRT puts because, they don't have any upcoming earnings. Let's take a look really quickly at what Thinkorswim Analyze tab has to say about them. SPRT. They are information technology, so it's not like you have this huge biotech company type risk. It did trade at a pretty low amount back in 2016, but I'm really more concerned on a month-to-month basis about what's been going on in the past year. And it looks like there's decent enough support at this $2-ish level. And even though our basis would be 385 off the bat, I think we definitely could get down there. Biggest question mark for me is going to be figuring out what happened here on March 19th to make it spike up in the first place. So let's scroll back really quickly, and that is the end of the news wire. We'll have to look somewhere else. But let's see. It looks like they have a September 10th date for a special meeting to vote on a merger. Okay. And the stock is a short squeeze candidate. So that makes the September 17th expiries a lot more risky because you have this big merger event. And the thing about mergers, which I like to harp on a lot because I love talking so much about, proper valuation of stocks, is that a merger alone does not increase the value of a company. If you're company A, the value of company A does not suddenly become value of company A plus company B. The value of the merged entity becomes the value of company A plus company B. Whereas, A and B retain their initial value. So it's not like, oh, great, this stock is about to merge, they're going to shoot up in value. Fundamentally, that's not the case. Now, whether or not people actually go out and buy the stock with that thesis is another story in itself. But in general, I don't want to trade on the thesis that people are going to make a dumb decision and buy the stock because of a merger. So that's probably something I'll stay away from. The numbers do look decent. The premium is through the roof, and like Rich mentioned, or like JM mentioned, it's on that high premium list that we sent out, and we've got that scan right here if we want to take a look at that in just a second. But just because something has a lot of premium doesn't mean it's a great trade. And I think this is a great example of looking at something that has a lot of premium but isn't necessarily the greatest trade, because that merger related risk isn't something I really want to see myself taking on as we head into September. So I think I'm going to leave that one alone for now. And with that said, we're just under an hour and a half on the stream, so we're probably going to wrap it up. We talked a little bit about some of the newer trades that we opened up. We recapped our previous week. There isn't a whole lot going on right now. Again, I'm really trying to stick with an overall conservative approach to the market, because if we take a look at the S&P 500, this is what we see over the past year. So, every now and then it's typical to see decent pullbacks in the market. We've seen 1, 2, 3, 4, 5, 6, 7 in the past year, and we really haven't seen one in the past month. So, I think we're kind of due for another decent pullback. I want to be really cautious, hesitant, and conservative with the amount of capital that I have as we move forward here, because I always like to say that it's so much more fun during a pullback in the market to have all of this money sitting on the sidelines and entering these cheap entries, as opposed to having to fight off a margin call when the market plays back. And like JM, like you're throwing in the YouTube chat, absolutely, the conservative approach, quote unquote, that we've used for the past few weeks has netted us out a really good amount of money and has kept us consistently green. And like we outlined at the top of the stream here, if UWMC stays flat, this might go to 0.95. This will expire worthless. This will expire worthless. This will be 0.67. These will expire worthless behind it. So we have enough, trades in play to alone, just from stocks trading flat, make us a 3.15% return on the week and do some serious damage. So beyond that, I don't really feel a need to keep loading up from here, but rather I'm going to keep an eye on the market like we did last week. There are always so many opportunities on a day-to-day basis that present themselves, and we really demonstrated that as we had all of these new trades last week. So again, another shameless self-plug right here is if you go over to hourglass-trader.com, you want to sign up for the HT Premium. You get all of these benefits: trade alerts, trade plans, our chat room, our premium channels in the Discord server. You could see this portfolio tracker. We've got a watch list, the option scanners we use, and that is how you are going to find out exactly what we're doing at the exact time that we're doing it if you want to follow along and learn with us. But even if you don't want to pay for premium, I totally understand everyone's financial situation is different. We still have our overall Discord server free to join. You just won't get the premium channels, but I think between that, the discussion we have in there, our YouTube channel, there's still plenty of value. Oh, JM, great question about Corsair. We talked a little bit about that one earlier at the top of the stream, but I think we're going to continue forward with the Strangle because right now our break-even price is what? It was 28.81, and we came up with the idea that if, coming to the week, I definitely agree they're due for a bounce, right? It's been a continued downtrend. It's been pretty gross. They're not a bad company. But if we stay doing exactly what we did, being a lot of, another HT Premium shout out, appreciate that one, JM. But if we stick with the conservative strategy of selling a straddle, meaning the covered call and the cash secured put are at the same strike, but if we stick with that strategy, we're going to be able to knock off, $1.10 plus $1.80, meaning about $1.90 off our break-even price, and further drive that down. So we'd probably end up with the break-even price right around 280. That's not correct. Hold on. $1.80 plus $1.10. There you go. 290. So yeah, we'd get a break-even price of around 26, which is below where the stock is trading. That is how you play defense. That would be considered mission accomplished. And we'll see. It all just depends what happens this week. And like we also mentioned when we did our little hypothetical moving around of prices here, this thing could bounce up to 27.5. These both expire. We're going to pull $3,500 off that, and then we could just never look at Corsair ever again, or at least not as big of a position moving forward. But one of those things, it plays out on a day-to-day basis. We may have an entirely different opinion on it come Friday, and that is something we'll be sure to discuss in our Discord server moving forward. But we are at the hour-and-a-half mark. Thank you so much for all of you who have tuned in and joined us for our weekly stock market scan. We do this every Sunday night at 9 p.m. If you are not already part of it, please, please, please come join us in our free Discord server. I think you could find the link on our YouTube channel, our Twitter. It's on our website right here. If you just click join our 24/7 chat room, it is literally free to join. You just click on there and you are right in with 2,400 other option sellers. So with that said, we are going to sign off once again. And I'm sure so many of you are probably very tired of hearing this, but I'm still going to say it. Thank you for watching. And this has been Hourglass Trader, where as time passes, we make money. We will hopefully see you all again next week. Hopefully see you during this week in the Discord server. And when we talk again next week, hopefully we have more money in our pockets than we do right now. So thank you guys, and we will